The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody. Welcome to our webinar for today. I hope you guys can all hear me. If you can just type in the question box and can you hear me clearly. Do a quick sound check. Great, thank you. Thanks, Johan. Great. Okay, so welcome to our webinar this week. We're talking about investing like the best. That's our topic. I've chosen this topic because as people these are the people that I read about, the autobiographies and things like that, and I really have admiration for them. Okay, so and I think we can also learn from them as investors. So here's the agenda for today. If you just get into it, we could do a quick overview or quick introduction to all the best investors. Now, there are a lot of investors out there, successful investors in history, and obviously some of them are still around today. And I've just taken 5 of some of the most well-known investors in the world, and we're going to discuss some of their methodologies and their philosophies and things like that. And the whole idea for you today is how can we copy these investment greats, these icons as such, and what can we learn from them? Okay, so that's my objective today with this webinar. Let's move on. Just want to check something quickly. Okay, everything's okay. I was still logging in. Awesome. Okay, so quick introduction. So most of us find ourselves, it's easy to invest when we're in the bull market. It's easy to be successful in the bull market. It's a bit harder when it's a bear market. Obviously, all the prices are falling. It's even more difficult to be successful when there's a market crash. Because the biggest enemy out there is human emotion, greed and fear. And obviously, when the market's crashing, everybody's fearful, everybody's rushing out of the markets into cash, etc. But saying that, these superstars we're going to talk about today make it look downright easy. Okay, they thrive when there's storms in the market. And that's why they are praised in the business world and also in the media, because they go against the grain. So we, as a lot of us individuals, we try and emulate their stock picks, but we find that it's not as easy as it looks to just copy them and do what they're doing. It's not as easy as it looks. The main thing for that is that these investors truly stand out. They're in a class of their own, and they're the very best in the world, and there's reasons why. Number one, their actions dictate what happens in the market, and number two, obviously they've made a lot of money, made money for themselves and their clients, but the secret is they've stuck to solid investment philosophies. They've developed their own investment philosophies, and they've stuck to it. And that's my objective for you today, to take what we can learn from these successful investors and then start creating your own, start personalizing your investment approach along the lines of investment strategy and things like that, but sticking to it. Okay, so this is a quick introduction. Let's talk about Benjamin Graham. Now, a lot of you might have heard of Benjamin Graham. Some of you might not have heard of him. He's most famous for being number one, the teacher and mentor to Warren Buffett, but more importantly, obviously, he's the father of value investing. Those of you that are value investors, it's thanks to him. And he wrote a very famous book, investment book at that time, called The Intelligent Investor. It's a big, thick book, not an easy book to read. It took me like a year to read it. But basically, this book spells out his investment philosophy. What I found interesting when I was doing my research on Benjamin Graham, that he was instrumental in many elements of the Securities Act of 1933, which is obviously involved with public companies disclosing independently audited financial statements. Obviously, made it law that you have to disclose certain information. Okay. But more importantly, obviously, he made a lot of money for himself and his clients by not taking huge risks. Okay, he based all his analysis solely on financial analysis, and that's how he became successful. And he's famous for coining the phrase margin of safety. He stressed the importance of having a margin of safety in your investments, and we'll talk about it a bit later. But basically what it means is buying a share or buying a company well below a conservative valuation of the business. And you'll see this now when we talk about Warren Buffett. He's got very, very similar methodologies. But Benjamin Graham, he went one step further. You can call a deep value investor. He looked at what he called the net tangible asset ratio, net tangible asset value, and that's looking at the cash value of a company. So he was very, very conservative. And over the years, I've been trying to find companies that meet that criteria. It's not so easy nowadays. Okay, I still have to find a company that meets these criteria. So he was very, very, very strict by looking for companies that had deep value. Okay, so what is the essence of Benjamin Graham's investment strategy? Basically, his philosophy was any investment should be worth substantially more than any investor is willing to pay for it. Okay, and we'll talk about it just now when we get to Warren Buffett. He talks about buying a share far below its intrinsic value. Okay, so, and I mentioned just now, obviously, financial analysis. He believes solely in fundamental analysis. So he looked for companies with a strong balance sheet. What I mean by that is companies with little or no debt, above average profit margins. We talk about a 5% profit margin being good, 10% margins being excellent. Those are the kind of companies he was looking for. But also very importantly, he looked for companies with ample cash flow. Cash flow is king, and obviously those are the companies you're looking at. So I'm just introducing you to Benjamin Graham. You can take a bit from him and then add it onto Warren Buffett, add it onto Phil Fisher, and then create your own investment philosophy, okay, or strategy. Let's talk about Warren Buffett. Obviously, he's more famous now because he's still alive, he's still around, but he's known as the Oracle or Sage of Omaha. He's acknowledged as the world's greatest investor, and the reason for that is he's been doing it for so long, decades long, number one. Number two, because of the amount of money he started with. He started with a small bit of money, and look what he's done with it. I think last I saw his net worth is $38 billion. He's the richest man one of the richest men in the world. I reckon the most successful investor. But he's also synonymous with running amazing businesses. Okay, he's a very, very good stock picker. So he knows how to place the best place to put money, the cash from his company, Berkshire Hathaway, and where to put that money as a home, or find a home for his money. In other words, he's very good at capital allocation. Okay. So a lot of people try and emulate Warren Buffett. They try and follow his every move and obviously do what he's doing, but obviously in their portfolios. Okay. You'll find also there's the annual pilgrimage to Omaha. They rent the whole football stadium, and they have 35,000 shareholders coming along to the AGM. And that's been dubbed the Woodstock for capitalists. Okay. But most of us, we try and just emulate or track what's happening with his investments by simply investing in his holdings. He's got a company called Berkshire Hathaway, I mentioned just now, Hathaway A and Berkshire Hathaway B. Hathaway A, by the way, if you can click on that link, it'll take you to the Google Finance page, and you'll see most recently the share traded as high as $229,000 for one share. At our current exchange rate of about 11 Rand 50, that's like nearly 2.6 million Rand for one share. So, and there's also a thing out there that Warren Buffett refuses to have a share split because he wants you to be committed to the company. Okay. So what can we learn from Warren Buffett? He's got a very simple investment focus. He looks for shares that are priced unjustifiably lower than compared to its intrinsic value. So the share must be trading at 5 Rand, but it's worth 10 Rand, for example, 10, 15, 20 Rand. That's the kind of thing he's looking for. So he chose stocks solely based on the overall potential of the company. So, you know, his analysis is very simple, and that's why I like it. Following him. It's one of my he's one of my heroes, and we'll talk about it again just now. But this is his investment style also. He's very disciplined, he's very patient, and obviously he sticks to value investing as a strategy. And that's how he's consistently outperformed the markets for decades. What's also interesting, you know, a lot of times you buy a stock, a value stock, and you're waiting for the rest of the market to catch on to the idea that the stock's undervalued, and eventually, obviously, you recognize that value and demand to push the price up. The challenge of that, sometimes it's just stays undervalued for a long time. So he's not concerned with that kind of thing. He's not worried about the market recognizing the share's worth. He's more concerned with how well the company can make money as a business. Okay, so his philosophy was thinking slightly different to us mere mortals, if I had to say that. But he's also been criticized for obviously avoiding technology companies and other industries. But he's very, very well known for he sticks to what he knows. He doesn't understand technology. He can't be able to explain it and things like that. But that's also the reason why he's been able to realize such amazing returns, because he sticks to what he knows. Okay. So there are a lot of stuff out. There's a lot of stuff out there on Warren Buffett, books and things like that. If you had to do a brief summary of his methodology, I was going to highlight 6 ideas here. 6 things you can ask yourself. Again, you want to incorporate this into your own investment philosophy. One of the things he looks at, has the company consistently performed well? So one of the measurements there, we use a financial ratio called return on equity. Basically, it's a rate of that shareholders earn on their income. So the average, let's say the average of the market is 15% return on equity, which is obviously, you can compare it to the bank, which is much higher. That's the average. You want to get something that's consistently above that. You don't want to have something going at 50% all the time, or 50, 60, whatever. Is that sustainable? That's what's important. So, anything above 15%, that gives you a good idea of performance of the company. That's on one side of the coin. Second thing you want to look at is obviously debt. Has the company avoided excess debt? Now, Warren Buffett uses a financial ratio called the debt-equity ratio. What part of the business is financed from debt? What part of the business is financed from equity? He prefers earnings growth being generated from shareholder equity as opposed to borrowed money. Now, the question always comes up, and what is a good debt-equity ratio? So anything below 75% would be considered okay. Ideally, below 50 would be even better. We at PhD prefer to use the financial ratio called interest cover, because the bill has to be, the debt has to be paid. What's more important is, can we manage the debt? So interest cover is how many times you can cover the interest bill out of earnings, and our benchmark for a large cap company will be 3 times cover, 3 times earnings. If it's a small cap, we'll say, okay, at least 5 times cover. Okay, but it gives you a bit of a benchmark from a financial risk point of view. The third thing that Warren Buffett looks at is, are profit margins high? Number 1. And number 2, are they increasing? As I mentioned just now, profit margins, 5% is considered good, 10% is considered excellent. So high profit margin is an indication that the company is executing its business well. If those margins are increasing, so we're going from 5% to 6% to 7%, that trend, it shows us that, number 1, the management is extremely efficient, but also very successful at controlling expenses. And that's the kind of thing you're looking at, okay, from a profit margin point of view. Point number 4 is how long the company has been in public. How long has it been a listed company? So, Warren Buffett likes a company with a 10-year track record. I find it a challenge to find resources that will give you 10-year track record. So a lot of times you'll find 5 years. But if you're really interested in the company, what I've done, especially like companies like Cecil, I actually I collect the financial statements. So over a period of time, obviously you'll be able to build up a 10-year 10-year record of financials. The whole idea is you want to find companies that have stood the test of time. So you want, the longer the history, the better. And that's one of his criteria he looks at. You don't want to go for a company that's just been listed, newly listed company. You haven't got much of a track record, so obviously it makes forecasting a bit more difficult. Point number 5: does the company's products rely on does the company rely on a commodity? Now I use example always of toothpaste. Okay, you can go buy Colgate toothpaste from Pick and Pay, and you can also buy it from ShopRite Checkers. You as a consumer, we don't care where we're buying it from. Obviously, when you're buying the same commodity, you just want to pay a lesser price. So he tends to shy away from companies whose products are indistinguishable from those of its competitors. So bottom line, he's looking for companies that's got a competitive edge or economic moat. Okay, so that's the one side of the coin. The other side of the coin, obviously, he avoided companies that rely solely on commodities such as oil or gas. Okay, so those of you that might be looking at the mining stocks, you're not a value investor. Okay, number 6, is the stock selling at a 25% discount to its real value? Okay, now on our PhD Online website, we try and simplify it for our clients in the sense that value stocks or undervalued stocks will be color-coded green. So we're using a PEG ratio, which is the PE ratio divided by the forecast growth. That gives us a PEG ratio. So we color-coded undervalued stocks between 35 and 75%. We consider that undervalued. From 75 to 125, you'll see the color code there is yellow. We consider that as fair value. And anything above 125, we consider that as overvalued. Okay. But also you get the other side of the coin where the share has gone so far undervalued, it's gone into below 35%. You'll see we highlighted blue. We're also highlighting that this has become speculative in the sense that there might be risk involved. Go do your homework. Okay. So this is where Warren Buffett is different to all of us. He's got this unmatched skill of accurately determining a company's intrinsic value. Now, and obviously after years and years and years, he doesn't have to go into so much due diligence. He can fine-tune it just with experience. Okay. But the whole idea is that he wants to determine the intrinsic value of the company. What's the real value of the company? The share might be trading at 5 Rand a share, but it's actually worth 10 Rand. And that's obviously undervalued. If the share is trading at 10 Rand, but it's actually worth 5 Rand, we say it's overvalued. But then what he used to do is compare that now to the market capitalization. And from there also decide if it's cheap or expensive. Okay. So that gives you some insight into Warren Buffett's methodology. So it's something you can add also onto your strategy as such. Let's talk about Phil Fisher. A lot of people don't know about Phil Fisher. Similar to Benjamin Graham. Benjamin Graham was regarded as the father of value investing. Phil Fisher was regarded as the father of growth investing. So totally different approach. What I liked about him, obviously he had his own little fund, investment firm called Fisher & Company. He started back in 1931. But he was involved with his company for until the age of 91. Over a 70-year period, he was quite successful. But obviously he was a long-term investor. What I like about it, and that's why I brought Phil Fisher into this presentation, is instead of looking at numbers now, we can start looking at things like the quality of a company. So Phil Fisher had 15 points, characteristics you look at. Obviously, you're looking at the management of the company, number two, and looking at the business. That's more qualitative versus quantity. Quality is looking at the quality company instead of looking at the numbers. So first of all, he's looking at the management. What is the integrity of the management? Do they use conservative accounting practices? Are they accessible? Can I go have meetings with them? What is the management's do they have a good long-term outlook? Are they open to change? Do they have excellent financial controls? And also number 7, does the company have good personnel policies? So that's looking at the management. So it's very difficult to try and measure that. I think that comes with experience again. But also, it's another different way of looking at a company. When it looks at the business itself, is the company growth orientated? Has it got high profit margins? Does it use a high return on capital? Remember, Warren Buffett uses high return on equity. Is the company committed to research and development? So obviously you want to go for companies with cutting edge technology, growth companies. And these are the companies growing faster. They won't be paying out so much dividends because they reinvest everything back into the business and they're growing fast. So you'll find that these companies will most probably have a superior sales organization. They're going out there and growing the business through sales, okay, through revenue. Are they in the leading position within the industry? I remember years ago we talked about MTN being a growth stock in that, but they were going through acquisitions. Okay, so there's different ways of looking at these companies. You can look at technology companies. You know, Facebook and these guys were leaders in that industry. That's why they've become so big. And then obviously, does this company have proprietary products or services? Comes back to that moat we're talking about just now. What's the competitive edge? So again, we can learn something from Phil Fisher, add that into your investment philosophy. What kind of stocks would you look at from a quality point of view? Okay, so it's a bit more higher up than looking at the bottom number. Let's talk about Peter Lynch. Now, I've read Peter Lynch's book, One Up on Wall Street. I found it very interesting in the sense that it was very easy to read, very easy reading style. But Peter Lynch basically, he combined a bit of fun, a bit of value investing and a bit of growth investing, and he came up with a thing called growth at a reasonable price. We have the acronym, the abbreviation would be GARP. But Peter Lynch is known for being a fund manager. He was a fund manager for Fidelity's Magellan Fund from 1977 to 1990. So over that 13-year period, He outperformed the S&P 500 index, which is a big, obviously a big market barometer. 11 of those 13 years, he outperformed it with an average return of 29%. Do you think you can learn something from this guy? Okay, yes. What I liked about his approach, yes, he looked at the financials, but before he looked at the financials, you just go walk about. Let's say, you give an example, walk around the shopping center, and you're seeing that people are shopping, more people are shopping at Foschini than they're shopping at Truworths. Why? Because obviously people like the clothing, they like the mix, people, the manager there is on top of things. Okay, and then you after having a positive experience of the company or the business, you'll go look at the financials of the company. Okay, so his investment style was described as a bit of a chameleon because he would adapt to whatever investment style worked at the time. That's why this growth at the reasonable price it gives you that bit of flexibility. But all idea, he was picking stocks that he knew, similar to Warren Buffett, but he also could easily understand. Again, something you can be able to explain to your 7-year-old son and simplify so your son understands it, then you're on top of your game. Okay. So what can we learn from Peter Lynch? He had eight criteria in his selection process. Know what you know. So obviously become a bit of a specialist. Those of you know that my background, I used to be in the hospitality industry. I first started at a Spur, and I was a Wimpy, I was a Holiday Inns, but I specialized in the beverage and hotel sector. Those days I said was Spur, and Wimpy was Pleasure Foods, and then Transun, Siskinet. Well, I was a bit of a specialist, and then I became a journalist. So that's what I'm talking about here. If you're an engineer, look at engineering companies. If you're in the medical field, look at the hospital, the healthcare, or the pharmaceuticals. Specialize in something you know, and from there broaden out. Similar to Warren Buffett, he also said it was futile to predict the economy and interest rates. He left it to economists, but he focused just solely on the companies themselves. Okay. He's also famous for saying that you have plenty of time to identify and recognize exceptional companies. Now, one of the books I read about him, he wrote about What Up in Wall Street. Another one was Beating the Street. He said all a small private investor needs is to find 5 good companies, and then get to know all about them and put all your money to those 5 companies. So you get all the time in the world to find those companies. That's what he's saying. Yeah. Number 4, avoid the long shots. These are the companies that are maybe a new listed company, no matter a track record. They might have amazing technology, they might have a lot of growth potential, but gee, these guys are not paying out any profits. Those are the long shots. He firmly believed in good management being very important, and obviously the whole idea is buying good businesses. Be flexible, be humble, and obviously learn from your mistakes. We'll talk about Warren Buffett just now. Warren Buffett also learns from your mistakes. Even a great investor like that can make mistakes. Before you make a purchase, you should be able to explain why you're buying. As I said just now, if I can explain that to my 7-year-old son so he can understand, then I understand the business. And then number 8, there's always something to worry about. So do you know what it is? So when I write my weekly newsletter, The Investor, I try and highlight the positives and negatives of the company, and that's the whole idea. Do you know what can affect the company? What can go wrong? Okay. Again, can we learn some from Peter Lynch? Can we add some of his ideas into your own investment philosophy? Yes, you can. So John Templeton, this is our 5th and last investor. He's not with us anymore. He's called Sir John Templeton because he was knighted by Queen Elizabeth for obviously what he did for England. He did a lot of things for England. Okay. He's the ultimate bargain hunter. He is the creator of the modern mutual fund, unit trust fund. He sold his Templeton funds way back in 1982 to the Franklin Group. He became very, very rich. But basically, how he started that is way back in 1939. He bought 100 shares worth below $1 on the New York Stock Exchange of every single company. Okay, trading below $1 a share. So he bought 104 companies in total, and his investment was $10,400. Obviously, back in 1939, that's a whack of money. Okay. But over the next 4 years, 34 of those companies went bankrupt. So the other 70 made him money. What was interesting to see that his portfolio went from $10,400 to $40,000. That's a 285% increase, or 71% per annum growth over that time period. Okay. So what he learned from this, he said, well, I realized that diversification, number 1, is important. Number 2 is also investing in the market as a whole. is important. So while some companies might fail, others will gain. So yes, that's how unit trust funds work. They have a wide spread. Some companies do well, some companies won't do so well, and that's how you get the average of the market, about 20% return. Okay. And I mentioned just now, he's described as the ultimate bargain hunter. He was considered one of the best criterions. Whenever else is selling, he wants to be buying, and obviously whenever else is buying, he wants to be selling. But what was interesting, he searched companies globally when nobody else was doing so. He was the pioneer in going global. Okay. He believed that the value stocks were those that were completely neglected. So those are the stocks that have been sold off and the market's ignoring them. And it's very similar to the Warren Buffett approach, value investing. These are the kind of stocks he was looking at. What I found interesting about Sir John Templeton, Warren Buffett's been staying in the same house for 30 years, been driving the same car for 30 years. I'm not saying he doesn't enjoy his money, but Sir John Templeton did. What I also like about him is that he lived in the Bahamas. Okay, so obviously a nice tropical island, but also I think the reason why he did it, he wanted to be far away from Wall Street, so he couldn't be influenced by the talking heads on TV, but also obviously newspaper opinion and things like that. And I think that's how he became more independent with his investment approach. Okay, so guys, I hope you've learned something. So how can you copy the grades? It might seem simple. The simple part is the approach. Go buy 100 stocks that are selling below the intrinsic value, using the value investor on Peter John's website. In other words, go buy 100 cents worth of assets for 70 or 80 cents. Okay, it's very, very easy to do that. That's the easy part. The not so easy part is actually being able to value it. Okay, we simplify the process for you. What's more important, can you pull the trigger and actually go buy the shares? So hopefully you guys can have a bit more conviction in your analysis and understand why. And obviously that's how you're going to make money. So the greatest opportunities occur in the midst of fear and panic. So yes, you might be in the situation you think, well, the market's overvalued, or it might be you might be scared to get into the market. But obviously with a low interest rate environment we expect this year, the markets will be going up. Yes, might be more volatility, but there's opportunity. These great investors have the ability to stay rational. They look at everything and they think about things clearly, and they stay unemotional. They look at the numbers and they are convicted. Okay, and they're committed to the investment philosophy. Okay, so what can we learn? And this is, as I said, I admire Warren Buffett a lot. This is from one of my favorite websites called fool.com. Warren Buffett is an incredible investor. What can we learn from him? 5 little pointers quickly. Warren Buffett knows how to hold stocks for the long term. And I think that's a big difference between him and us. He's been involved in doing the value investing for more than 30, 40 years. Okay. He owns up to his mistakes. He made a mistake once when he bought a share without consulting his business partner, Charlie Munger. And he admits that mistake. He said you'll never do that again. It's good. You admit your mistakes, own up to it, but don't repeat it. He knows what he's good at. He's very good at stock picking. He's very good at valuing a company. And the rest of the stuff he leaves up to his business manager, the running of the operations and things like that. He leaves that to others. He sticks to his circle of competence. He sticks to the companies he knows. He puts his money where his best ideas are. He's a big investor in Coca-Cola. He's a big investor in Gillette. Okay. He clearly communicates his investment approach. That's why we have his big AGMs, because everywhere he goes and learns from him. Okay, you must get hold of one of these Berkshire Hathaway financials and read about it, because he clearly communicates his investment approach. As I say, that's how we can learn from it. And the best time to buy is when nobody else is. So he's obviously contrarian. And he knows what it means to be patient. That's going back to point number 1. He holds stocks for the long term. And this is, I think, a lot of us get impatient. The stock's not doing anything. It's being undervalued. The market's not recognizing it. He'll sit and wait. Okay. He says, number 9, he says that we have it easier than him. Obviously, we just follow him, but obviously, yes, you go out and do the initial analysis. Warren Buffett himself learns from others, and we're learning from Warren Buffett. And number 11, he does not hang out in the stock market. He doesn't get hung up on stock market forecasts. He doesn't forecast interest rates, doesn't forecast what's happening with the economy. He looks at individual companies. Okay. And point number 12, Warren Buffett maintains a healthy diet. Nah, just kidding. Those of you who've seen him on TV and things like that, he loves his cheeseburgers and he loves his cherry cola. So I just put that in just to see if you guys are awake. Okay. So no, he doesn't have a healthy diet, but obviously he's going on at 84, 85 years old now. So yeah, he enjoys his food. So guys, I hope you've enjoyed it. Just a quick summary. Benjamin Graham, father of value investing, we can learn from him. And I suggest get hold of that book if you can. I know I got mine years ago as a soft cover from incredible, exclusive books. Warren Buffett, there's quite a few books written about him, but I believe you can learn a lot about him from a value point of view. Phil Fisher, he's also written a few books. Offhand, I can't remember what his book was called. Peter Lynch, I mentioned before, One Up on Wall Street was the famous one. That's where he coined the phrase, the 10-bagger, making 10 times your money or 1,000% returns on your money. But remember, here's a whole approach, and that's one of our strategies on our website is growth investing. So John Templeton, the mutual fund investor, those of you that are into mutual funds, just think that you are the pioneered the global mutual fund. So these 5 investors differ widely in their strategy and philosophy. Some of them were used new and innovative ways to analyze investors. Others were very, very astute at picking securities purely by instinct. Okay, what can we learn from these guys? Okay, they consistently beat the market. Why? Because they have investment philosophy. And that's what you want to try and do. So in conclusion, if you haven't got an equity trading account with us yet, and I say a trading account, just think about a long-term investment account. You want to open up a long-term capital growth and income equity portfolio. Okay, and obviously using this, developing your own investment plan. And your first investment always is in your financial education. You want to develop your own investment philosophy based on fundamental analysis, but also understanding valuation, how to value a company. So ultimately, you want to get to the stage where you have certain criteria in your share selection checklist. Does the share meet my criteria? And from there, do further analysis. You need to develop patience and discipline by sticking and working on your investment philosophy. So it's a bit of a work in progress. Nothing is chiseled in stone, but it gives you a guidance. That's the whole idea. So guys, this presentation, the PDF version of this PowerPoint presentation will be sent to you, as well as this recording will be emailed. So from my side, good luck and happy trading. Before we tackle any questions, let me just highlight some upcoming events. Our webinars on the 8th of February, the question there is, should I invest offshore? And the answer is definitely yes. Okay. Yes, the rand has maybe pulled back a bit. But you can foresee that the rand will be more volatile, number one. Number two, the rand should be a bit weaker. But I believe that the offshore is where the opportunities be lying this year. We're having a presentation on Monday, the 23rd. And so we've got a guest speaker, Ronald King, is coming to talk to our clients. Are you ready for 2040, which is 15 years' time? So a bit of financial planning in there. On the 11th of March, I'm going to talk about trading CFDs. I have a lot of requests about derivative products. We're going to tackle CFDs in this example. And then in the middle of March, we're going to talk about how do I select shares for capital growth and dividends. So basically highlighting the investment research platform. How do I use that criteria in a bit more detail? Okay, and how to create a watch list. Our Traders Forum, those of you down in Durban, I'm there in 2 weeks' time, the Blue Waters Hotel, 17th of February. And then for the first time ever, I'm coming down to Bloemfontein. So if you know anybody in the Bloemfontein area, please tell your friends and that can come along. I'm at the Southern Sun in Bloemfontein, and our topic there is trading for a living. Okay. So guys, thanks a lot for your support. I hope you've enjoyed this presentation. There's my contact details. So, yeah, enjoy your day. We'll talk to you guys later. All the best. Bye for now.